Okay.
Okay, guys. Yeah, we're recording now. So I'm here with Andrew Gordon. So Andrew, I've known for a handful of years. Andrew runs a tax firm and also an accounting firm based out of Chicago, right? So thanks so much for coming on, Andrew. We're going to have some really good stuff to go through here today. We appreciate you being here.
Hey, yeah, thank you. Thanks for having me.
Yeah, there was a little bit of a delay there. Can you hear me okay on your end?
Yeah, I can hear you fine. Yeah, thanks for having me. Hopefully, audio will continue to work.
Yeah, it should be fine.
Okay.
Cool. So, the main reason why I wanted you to have you come on here is we're coming up towards the end of the year, and I'm sure there were a lot of people in the affiliate marketing industry that made some money this year, right? And part of an important strategy is not only making money but also keeping money. So, Andrew, I think you've got some really good insights that we can share with the group. Certain strategies and things that affiliates should be cognizant of around tax season for sure. So, why don't you start off by talking about just like the differences of the ways that you can structure your business and ways that you could potentially save money by just restructuring your business a little bit.
Yeah, absolutely. So I guess to begin, again, thank you for having me. I'm an attorney. I'm also a CPA, but I'm not your attorney, or I mean, I may be Tyler's, but I'm not the listeners out there. I'm not your specific attorney, so you should always consult an attorney for your specific case. But today we're going to talk just about some of the general aspects of entity formation, also taxation. We're coming up on the end of the year. A lot of people are now realizing that they made a lot of income during the year, which is a great thing. But unfortunately, that often also means that you're going to have a tax burden. And for affiliate marketers, internet marketers specifically, and in general, contractors, the federal government or your employer is not taking payments out of your checks every time you receive a check. And so it's really on you at the end of the year to determine your taxes and to pay those taxes. So while someone at McDonald's may have all their taxes taken out of their paychecks, as independent contractors, we're not in those situations. So we have to actually pay those taxes. And so the end of the year is often a tough time for people because they're realizing, oh, damn, I have a lot of taxes due because I made a lot of money. And so one of the strategies that you can use to help minimize taxes, and this is something we're looking to 2020, those that don't have it, is to form a business entity, form an LLC, or we'll talk about some of the other options like a corporation or an SCorp. But in many cases, it's beneficial to operate your business through an entity rather than just a sole proprietor. There's both tax reasons in some cases, but also just from a organizational and bookkeeping standpoint. You would be surprised how many deductions you may forget or not be able to take advantage of just because your record keeping isn't good and you didn't have a business bank account and an actual business to run your expenses through. So just as a starting point, I often recommend to our clients to form an LLC. One of the most frequent questions that we're asked is, does it make sense to form an LLC? Should I be a corporation? Should I be an S Corp? Well, the reason that we often recommend an LLC is because it has the flexibility to become essentially any of these other things. And an LLC can later on elect to be taxed as a corporation. It can elect to be taxed as an S Corp, or it can just stay as a LLC. LLC is you're a single member owner of an LLC. So say you have a business, it's just you. You're the only person that owns it, and you form an LLC. From a tax filing standpoint, it's no different than if you were just a sole proprietor. It's on your own tax return, super easy to do. If you had multiple partners, then you file a partnership tax return with an LLC. Often, it's beneficial to be an S Corp. So if you look at the different options of business structures, LLC, corporation, S Corp, generally an S Corp is the most advantageous. There's some tax savings that you'll accomplish by being an S Corp, but there's also some downsides, other requirements that you have to comply with. And the biggest one is that you have to pay yourself a salary, and actually what's referred to as a reasonable salary. Now, what do I mean by paying a salary? I don't mean you just take money out of your business account and pay it into your personal, but that you actually process payroll. You pay federal taxes, Social Security, Medicare. You file a payroll tax return, just like you would with any employees, although you may be the only employee in an S-Corp. But that's one of the requirements of an S-Corp, is that you go through the process of running payroll. And so often for businesses just starting out, they don't know if they're going to be profitable. They don't know if it's worth the time expense to run a salary. You can start as an LLC, and then later on, it's fairly easy to make a late election to convert to an S Corp. And that doesn't have to be the first year, doesn't have to be the second year. So in many cases, you can start with an LLC, see how business goes, and if it makes sense to make a change to an S Corp, you can then make that conversion. It's a fairly simple process. The IRS almost always grants it. We do it for our clients all the time. So yeah, does that answer it?
Yeah, for sure. So it sounds like with the S Corp, you have a lot more kind of savings options. Could you talk about just like the differences of how you would actually get paid with an S Corp? Because like with an LLC, you can just pay yourself kind of whatever money you want out of business. But from what I understand with an S Corp, there's a little bit of a difference. Like you have to pay it out in dividends, or, pre-dictate what the salary is going to be, right? So can you talk about that a little bit?
Sure, absolutely. And that's a great question. So with a sole proprietorship, so a sole proprietorship is basically a nothing. It's not an LLC. It just means that you start a business in your own name. If you're a sole proprietorship, a partnership, an LLC, or an S Corp, all of these are referred to as flow-through or pass-through entities. This means that whatever the income is of the business, it flows to the individual owner. And so if you made $100,000 in your business and left $100,000 in the business in an LLC, you as the owner would still be taxed on that full $100,000. That is true of a sole proprietorship, an LLC, partnership, S Corp. It's true with all of them. So regardless of how much money you physically take out of the business, you're taxed on the income. And so if you take money out or you don't, that doesn't change necessarily your tax. You're still taxed on the income. But there's some differences, as you've identified, in how the money actually comes to you. So in an LLC, you take draws as an owner or a member, which basically means that you take money out of the business. You transfer it from your business account to your personal account. Again, that's not a taxable transaction. Let's say hypothetically you make 100,000 for the year and you pull out 50. You still pay tax on 100. Say you make 100,000, you don't pull out anything. You still pay tax on 100. Say you pull it all out, full 100. You still pay tax on 100. So the draw doesn't impact the tax, but in an LLC, you just transfer the money. In an S Corp, it's a little bit different. There's two components. First, you have to pay yourself a salary, which means you've got to run payroll. And often that's a percentage of your overall income. And so for conversation purposes, let's say you make 100K and you run a payroll of 50K to yourself. You don't have to run the payroll every 2 weeks. You don't have to run it every month, but you have to at least do it once a year. And so say you, out of that 100K, you pay yourself 50,000 in payroll. Taxes are taken out. Let's pretend 30,000 actually hits your bank after the taxes are taken out. That's one portion of your income. Then there's still that 50K that's still in the business bank account. Similar to an LLC or a sole proprietorship, you can take draws in an S Corp. And so you could draw that 50K or leave it, and you'd still be taxed on the income of the business. And so the complication is in an S Corp, there's really two buckets. You've got salary and then you have draws, but in an LLC partnership, you only have one bucket. You just have the draws. And so that's why S Corps are a little bit more complicated. There's additional tax forms. Both the S Corp has to file a return. You have to file payroll returns. So they're a little bit more complicated, but generally speaking, you'll save a bit in taxes. And so that's why it kind of depends on your individual situation. Does it make sense to go through those additional headaches to save taxes? And in many cases it does, depending on your income, especially as your income increases, there's greater benefits to being an S Corp. Mm-hmm. And so it really kind of depends on where you're at.
Yeah, sure. So I've got a couple additional questions about the S Corp. So let's say that you lived in the United States and one business partner is living in a state with very high state tax, is it possible to form the S corp or the C corp in a state like Nevada or Florida or somewhere that just has like a very small state tax or no state tax? Is that a workaround for somebody that maybe lives in like a high tax state?
Yeah, that's a great question. The unfortunate answer is no. And honestly, this is probably one of the most misunderstood aspects of tax law, especially by entrepreneurs and independent contractors. You pay taxes as a business owner, as an entrepreneur in the state that you live in. Because again, all these entities are pass-through, flow-through entities, which means all the income goes to you. So if you are domiciled, if you're a resident of California, it doesn't matter if your LLC is in Nevada, you will still pay taxes in California if you're living and working in California. Now, if you were living and working in Nevada, different situation. But the question you bring, Tyler, is, say, for example, I'm in California, my business partner's in Florida, and Florida has no state income tax. California has a very high state income tax. Can I just form in Florida and avoid it? No, because let's say we're 50-50 partners. Even if we form the Florida entity, at the end of the year, the income is going to be split between the two 50-50 partners. And so me living in California, I'll report that 50% income on my tax return, and I'll pay California taxes. So generally, it doesn't necessarily matter where you form. It matters where the business is operating or where you're living, and that's what triggers the taxes. That doesn't mean that there's not sometimes benefits to forming in other states like Florida or Delaware, but typically that's not going to change your requirement to pay taxes in the state you live. You actually have to move.
Sure. What about a self-employment tax? Is forming an S corp or a C corp a way to avoid paying self-employment tax, or no?
Yeah, and that kind of gets to the core of how S corps are beneficial. If you are a sole proprietor or an LLC, you are going to be hit with self-employment tax. And so if you take a look at, if you were an LLC last year in 2018, if you take a look at your tax return, on the second page, there's a calculation of the tax, of standard tax, but then there's also an additional tax called the self-employment tax. And this only applies to people that are self-employed, have LLCs, sole proprietorships, or so forth. S corps don't get hit with this tax. And that's because there's this concept that essentially S corps are separate from their individual owners. And that's why you have to run a payroll, because it's separate from you. You have to be employed by it. So in having an S corp, you're not hit with self-employment tax, but the IRS still gets much of that tax. And that's because the portion that you run through payroll, you are going to pay those taxes. The portion that's not through payroll, that you just take draws, will not pay those taxes. So in our example, we had 100,000 of income. We did 50,000 as salary, 50,000 in draws. The self-employment like taxes will hit the 50K that was salaried, but the other 50K won't. And that's why it's often beneficial to be an S corp, because if you were an LLC, it would be the full 100%. But by being an S corp, we're able to only pay those taxes on the wage portion. Now, the game that often people play is to try to minimize their salary, because if you pay yourself no salary or very low salary, then the rest is not subject to self-employment tax. But that's why the IRS mandates that you have to pay yourself what's referred to as a reasonable salary. And reasonable is a term of art, and it gets complicated figuring it out necessarily, but you've got to pay yourself something that's reasonable. And that portion will be subject to those taxes.
Sure. Yeah. So just on another topic here. So a couple weeks ago, you posted something in the group talking about basically a new law that was passed in 2018 that would potentially provide some significant tax savings for people that might be in the affiliate marketing industry. Could you talk in more detail about what that is and how that would work for people?
Sure. Yeah, absolutely. And this is one of the best ways to minimize your taxes. And it's called the Qualified Business Income Deduction, or QBI deduction. But it takes a little bit of planning in some situations to be able to maximize this deduction. A little bit of history. This came out of the tax reform that Trump passed about 2 years ago, which impacted tax years 2018 and forward. And so for 2018 and now this year, 2019, there's this new deduction, the QBI deduction, and it allows you to take up to 20% deduction of your income. So if you make $100,000, it will reduce it up to 20%, or now you only have 80,000 of income. That's a pretty big reduction. But there are rules. First, for certain types of businesses, it gets phased out. The government says, well, if you are, for instance, a lawyer and you're single and you're making over $157,000, that 20% starts to be reduced as you make more and more money till it eventually is eliminated if you're a lawyer making over $200K. It's not just lawyers. Other consultants, accountants, other types of service professions also have limitations. But most e-commerce businesses, internet marketers, and affiliate type entrepreneurs don't fall under those criteria. So first of all, most affiliate marketers, although you should talk to an attorney about your specific business, will be eligible for the QBI deduction. So we meet the first test. Now, the second part, though, is that if you make over that amount, 157,000 if you're single, and double that if you're married, if you make over that amount, the IRS then starts to look at how much you pay in wages. And if you don't have employees and you're not paying wages, then that starts to get reduced. So for people in this industry, people that are watching this video, if you are if you're single, making over $157,000 in your business, you may want to pay close attention to the QBI deduction before the end of the year. Because often by paying more in wages to yourself or even employees, you will be able to increase the deduction and save yourself more overall in taxes. So sounds contradictory, right? I'm going to pay more wages to save more in tax, but this deduction works often in exactly that way, that you sometimes have to do that to pay more in wages to maximize or take the full 20% deduction. This becomes even more important with SCorps, because if you're an LLC and you're saying, look, Andrew, I'm an affiliate, I made $250K, I'm single, I'm an LLC. It's going to start to get phased out. So it becomes even more important. There will be better benefits to being an SCorp because number one, you'll have the SCorp benefit. Number two, you'll salary yourself, so you'll be able to maximize this deduction and kind of through those two, minimize your taxes even more. So these are things you'd have to do before the end of the year because the wages have to be paid in the current tax year. So the things, if you're listening, what to pay attention to, you're making over, call it roughly 150K in your internet business, it's probably worth an analysis of if you're not already an SCorp, should you be? And if you are an SCorp, are you paying yourself the appropriate amount in salary to maximize this deduction? Because it can be considerable.
Yeah, awesome. So yeah, those are some really good insights there. I think that pretty much anyone who has an established business and is making money that isn't an SCorp or a C-Corp, and hasn't taken advantage of these things, it sounds like there's some significant amount of savings on the table. So thank you so much for sharing all this. I don't want to keep you on too long. I know that you've got a busy schedule for today. So if anyone wants to reach you, what's the best way for somebody to contact you?
Yeah, we have a very active Facebook page, Gordon Law Group, also GordonLawLTD.com, or message us on Facebook.
Awesome, man. Well, thanks so much for coming on. I'm sure that people are going to get some really good value out of this in the group. So yeah, thanks so much, and talk to you soon.
Yeah, thank you very much for having me.